Hello, everybody. Happy Thursday. We almost made it. Almost made it through the week. And man, I just love that intro music every time I hear it. And yes, that is the beginning. I don't think I've ever said this before. It is the beginning of Earth, Wind, and Fire's Fantasy, but that is actually not their version of it because we probably wouldn't have the copyright for that. That is my Russian friend band, who many of you know about. That is their version of it, which I do have the rights to it. So, uh, one of my favorite all time songs. Anyway, hopefully, it gets you all pumped up for our daily chat. So, how's everybody doing? Can you all, Alonzo, hello to you too. Can you all hear and see me okay? And we're going to start off the day by smashing the like right away. Right away. So, sound coming through, video coming through, everything good? All right, Thomas, thank you very much. So, what we're going to talk about today is very, very, very good one. Good one. I like that. Um, Very prescient to the markets right now. In fact, Hector, one of the students, yeah, good one, Bear. I'm not sure. I got to figure that one out. Um, one of the students in the OV room happened to bring this topic up today, completely separate from a discussion that we didn't have. And it is really, really important because it's almost like, here we go again. All right. So, with that being said, we are going to talk about treasuries. We are going to talk about that other side of the market. Not really sure if many of you know this, but as big as the stock market is, as big as the equity market is, the treasury market is even larger. It is even larger, and it is so important to our everyday lifestyle. It is so important to our wallets. And I'm not saying you have to be a master in understanding the treasury market, but boy, oh boy, understanding just a little bit of what goes on there can really go a long way. Just in your own particular economic outlook, your own particular maybe positioning. And I'm not talking about day trading, I'm talking more about going on as an investment, longer term investment. So, really, really important to talk about treasuries. So, there are treasury auctions all the time. If you're watching CNBC, Bloomberg, Fox Business, they'll break in, especially Rick Santelli on CNBC. He'll break in. It's not daily, a couple times a week when there are treasury auctions, and he will put a grade on them, A, B, C, D. And what that grade he is talking about is how well received were the auctions, how well received from the price that the Fed set for the public, institutional investors, whomever, to accept what they were offering. So let's first dive into the different types of treasury securities. The shortest dated ones are T-bills, treasury bills. We call them T-bills for short. Okay. So T-bills are short-term securities that can have 5 different lengths of maturity, from 4 weeks out to 1 year. Okay. Now, these treasury bills, when the government puts them up for sale, they sell them at face value or at a discount to face value. Excuse me. And when they mature in 4 weeks or 8 weeks or 3 months, whatever that duration is, you get paid the face value. Okay. I guess I probably should have taken a step back here for a moment. Is why does the government sell securities, treasury securities? Obviously, they do that to raise capital. Okay. And we all know, regardless of what, memes and political ideologies are out there, we all know that US government securities are the safest investment in the world. Okay. So, what happens when there is a lot of panic out there? What happens when there's a risk off appetite in the marketplace and people don't want to be in the stock market or don't want to be in crypto or whatever it might be, what do? They buy up US treasuries. Okay. We're going to get into how that works, pricing, interest rates in a moment, but let's go through the other sorts of treasuries. So if you see T-bills, short term. Now, treasury notes, kind of mid-level term. Those are 2 to 10 years. Duration is 2 to 10 years. Okay. The one most followed treasury that we all watch, that the government watches, that all of the talking heads on TV watch, that's the 10-year treasury note. Because, and we're going to get into this momentarily, the 10-year is the kind of benchmark, the barometer for what our loans are really based off of, whether it's your car loan, your mortgage. And notes, treasury notes, those do pay interest. They pay interest every 6 months. Now, treasury bonds, okay, so we've gone from bills to notes to bonds. Okay, bonds are the longest term sort of treasury that the government issues, 20 and 30-year bonds. Okay, they also pay interest every 6 months. Okay, historically, treasury bonds had been 30 years. More recently, they added 20-year terms as well. In fact, one of the tickers that we watch really closely on the equity side of things, excuse me, is TLT. TLT is an ETF, so it's an equity that we can trade options on, or you can buy the ticker if you want, that replicates as close as possible the 20-year treasury bond. Okay, so let's go through how pricing, excuse me, I still cannot get rid of this cough. It's been like 6 weeks. Unbelievable, and I apologize for that. So let's go through how pricing works on the short-term notes, on the bills, okay? As we just said, bills, treasury bills are short-term, 4 weeks up to 52 weeks, 1 year, and they're sold typically at face value. Face value is called par, okay? I wish I could shoot par on the golf course. Anybody here a par shooter? I'm like an 8 or 9 handicap. I wish I was par, but anybody here a 0 or even a negative? Because if you are, I want to play golf with you. So anyway, okay, when those notes, excuse me, when those bills mature, you get paid the full value. So the difference between the face value and the discounted price that you pay, that's essentially the interest you're collecting along that time. Now, remember, because these are short term, bills don't pay interest every 6 months like notes and bonds do. Okay, they just mature at par value, at full value. So to see what the purchase price is, okay, there's a formula. There's a mathematical formula. I'm not really going to go into it. I mean, it's actually fairly simple, and it's up here on the screen. Okay, but for example, here now I'm going to really see, Bear, if I can get my drawing tool to work without having to fumble around and around and around and around. Oh, yes. Okay, there we go. Wonderful. Okay, so $1,000. You're a 19, John? We got to play. But I bet you're less than a 19. You're a sandbagger, aren't you, John? I know it. I know it. Anybody with the handle Pro V1 who's playing with Pro V1s, you're a sandbagger, man. We got to get out there. Anyway. Okay, let's say there's $1,000 bill. Okay, 6-month maturity, 26 weeks. Okay, and it's at auction for a discount, like I have here, of literally 0.145%. Okay, if we take 0.145% of the face value of that bill, which is $1,000, Look at the time frame, 26 weeks, which is 182 days. Okay. That gives you a price of $999.27. You had a discount of 73 cents. Okay. So you would pay what would I say, 999.27, and 26 weeks from now, you're gonna get paid. Okay. This was just an example. Okay. Now, on something like that, that would be an interest rate, not really very much, right? But this is just an example here. That's how the short term securities work. Now, short term securities, like bills, are really, really important. Okay. People will use them both individually, and businesses will use them to just park some cash for a very short time. So let's say they know they have a big expense coming up in a couple months. Maybe you're a business and you're buying a new building, manufacturing equipment, whatever it is, and you know that expense is coming up and you have the cash right now. You don't want to, have any risk with it. People will park them in short-term bills. All right, moving on. From bills, we go to bonds and notes. Okay. Bonds are the longer term maturities, 20 and 30 years. Notes are those mid-level, mid-term maturities, 2 to 10 year. They pay interest every 6 months. Okay. And that interest rate is set at the auction time. Okay. So again, government puts these out there. You and I want to go in and buy them, and there's a price set for these. It could be at face value, which is par value. And depending on the supply and demand of the marketplace, that price could actually be higher or lower than the par value. So that pricing all depends on yield to maturity. Think of it as expiration. Okay. And what the prevailing interest rate is at the time. So here's kind of an overview. And can everybody hear me okay? Is everybody following along? Because the last comment I have in chat here is, all right, thank you. John Pro V1 saying he's a 19, which I am disputing. I want to see his index card on that, John. You got to send that to me. And you know what? Before we go into this, let's go real quick. Let's hit the word of the day. We'll start getting those up there. So let's get those up here really, really quickly. And while you're all doing that, I'll give you a quick market update because I see S&P's just rallied about 20 points back into the green on the day. I mean, this market is really there's no rhyme or reason. It is just a fluid news flow. What is going on right now? All right. Getting back to where we were here. So here's an overview of bills versus notes versus bonds. Okay. We've already talked about the duration. Okay. Interest wise, interest payments. Okay. The short term treasuries, the bills don't pay any interest. The others, the notes, the bonds, they pay interest every 6 months. How they're priced, you can see here. The shorter term treasuries, so the bills and the notes, the market is, I'm going to use an analogy here. Let's say we were looking at an option market, going to put a trade on, and we saw a really tight market of, a nickel wide between bid to ask. That's pretty much what you're getting with bills and notes. Okay. Unbelievably liquid, tight markets. That's great. Now, what happens, guys, if you want to go trade a leap option, an option that's 12 months out or maybe 2 years out? If you go to look on your platform And I don't care if it's Apple, Nvidia, Microsoft, some of the tightest markets out there, or if it's any other stock. What are you going to see happen to the market on those particular options that are further out in time? They're going to widen out a little bit, right? Because they're not quite as liquid. Doesn't mean they're not safe. They absolutely are. But the liquidity in the longer dated bonds, 20 and 30 year, okay, little bit wider. So the liquidity or the markets are wider. So the liquidity is a little bit lower. And then interest rate risk, think about it. If you have something that's expiring in 4 weeks, right? Not a lot of risk. Midterm could have a little bit more risk. Obviously, you get yourself into a 20, 30-year commitment, you've got more interest rate risk. You don't have risk of that bond defaulting, losing your money, but you do have interest rate risk. I put up the current yields up here just so you guys can see it. Again, that 10-year, and this was actually from like a day or two ago. The 10-year right now is, I want to say it's under 430. Yeah, it's 429. It was just trading 470 literally like 3-4 weeks ago. And you can go back, you can read all the pundits out there and all the experts out there saying, oh, 5%, we're going to get there in a heartbeat. Here we are sitting at 430, down 40 basis points from there. So now about that 10-year I was talking about. Okay. 10-year treasury note, that is the most closely watched government bond because, like I said, that is the benchmark how banks calculate their loans, mortgage rates, auto loans. Okay. That is by far the most liquid treasury that is out there. Okay. Now, when there is thoughts of a recession, okay, which we went through this from like 22 to 24, right? When every day the headline was, we're going into a recession, we're going into a recession, we're going into a recession. It never happened. Okay. But when the thought or the prevailing theme out there is that things are slowing down, we're going into a recession, and there's a lot of market uncertainty. Remember what I talked about before, when there's risk off and uncertainty, where do people go to park their money for safety? They go to bonds. The 10-year is typically where they will go. We will see a very big increase in trading volume. And if all of a sudden people want that particular asset, so the demand is higher than the supply, what happens? Okay, what happens in that instance? This is where a lot of confusion comes in for people that don't really understand the bond market. Elisa, Bill, excellent. And if the price is going up, okay, this is the part that gets people. If the price of these bonds are going up, what's happening to interest rates? Excellent, Elisa. Love it. You passed Econ 101 with me. Side by side. We were 1 and 2 in our class. Exactly. So bond prices and bond yields are inverted. They are opposite of one another. Think of it this way. If you can't quite grasp that concept. The government is selling these bonds, okay? And they're offering you a percent. Let's just call it for safety purposes here. Let's say they're offering the 10-year to you and they're going to give you 4.5%. Okay? But all of a sudden, everybody wants these bonds. Everybody wants to park their money in safe money. Well, what does the government do? They don't have to offer 4.5% anymore. They can offer 440, 430, 420, whatever it may be. So think of it that way if you're having a little bit of confusion, which is completely normal, that yields and treasury prices are inverted to one another. Okay? So hopefully that helped. Now, on the flip side of the recession discussion, when we're in a big area of expansion, when the economy is really expanding, okay, what do people do? They go risk on. What does risk on mean? Typically, that means they are selling their bonds. They no longer want the safety. They're selling. So now the government has competition because Joe Smith might have bonds that he's selling, and the government is selling, and there's competition. So now the price of those bonds go down and the rates go up because the government now has to offer a better incentive, a better rate for people to buy those bonds. And that typically happens in when we're in expansion phase because people want that money to go put it elsewhere where they believe they can get a better return. Okay, does that make sense to everyone? So that led me into this slide right here. Bond prices and bond yields are inversely related. As the price of a bond goes up, yields decrease. As the price of a bond goes down, yields increase. Okay, even if you don't fully understand the economics behind it, the dynamics behind it, okay, you really should just kind of understand how the bond market works like that. It's really, if you break it down, just like everything else, what does it come down to? It comes down to the basic economic principle of supply and demand. If somebody wants what I'm selling really bad, I'm gonna raise my price, right? And if nobody wants what I'm selling, I got to lower my price. Same thing in the treasury market. Same thing in the treasury market. All right, let me put this up here again because now we're going to talk about something that Hector in the OV room brought up just a little while ago that is now like all over the TV. I mean, I've seen it on. I've got CNBC on the background up here, and I've probably heard him talk about it 24 times today. But let's get this up here, guys, again one last time, so all of you can get your word of the day in, please. While you do that, S&Ps are staying in the green for right now. Nvidia is still hanging out down around $4 or so, down 3.5%. We have that contest from yesterday, guys. Don't forget, for closing price for Nvidia today. Okay, so let's look at how we compare these rates. Okay, you would think, right? Logic would tell you that if I'm willing to give you money for a longer period of time, I got to what? I got to get a higher return, right? Okay. That is what the normal or positive yield curve looks like. Just like when we identify, when we look at the volatility curve, a VIX curve, and we see that VIX futures in the future, are tick higher and higher and higher and higher, or if you look at oil futures, whatever it might be, that's a positive curve. Okay. However, when the near term, okay, again, I want to equate this to things that we've talked about in the equity and in the option space, like backwardation and contango. What's it like when all of a sudden the current pricing, or let's say this week's VIX futures are trading 20, but next week's are 18, or this week's oil futures are trading, let's say 70, and next month's are trading 68. All of a sudden, now the curve has shifted. What does that mean? That means more people want the near term. Well, when that happens with yields, and typically we see on TV, and if you look it up, the yield curve, the benchmark yield curve comparison that we look at is the 210. Okay, it's the 210. Government likes to look at the 3-month versus the 10-year. And just yesterday, the 3-month note, okay, was yielding a higher rate than the 10-year. When that happens, the curve becomes inverted, and historically, that can be an indication, okay, of a recession, that things are slowing down. Now, that's historical. We all know that old adage of, past performance not necessarily indicative of future performance. There is no study out there, that's 100% of the time. Okay. However, historically, that's been a pretty good marker. Now, for the last 2.5 years, we have seen that inversion. In fact, the bond markets just got uninverted, if that's the right name, I guess, normalized. Okay, just a short while ago, but now we're inverted again. So the fear, the risk, you're going to start seeing this, guys, ad nauseum on every business news channel and probably every publication you read. You're going to start seeing, oh, the risk of recession is back. Whether we go into recession or not, who knows? Everybody's been thinking that for the last 2+ years, and we haven't. Is this time different? Maybe. Who knows? I don't know. But it is really important to understand the fixed income market. That's the treasury market. I'm going to go back to this one here for a second. So if anybody wants to take a screenshot of that. Okay, so when rates drop, I'm going to leave it with this because the wheel's closed and we're going to go to the wheel. I'm going to try and put this in just kind of day-to-day bond introduction to bonds 101. Okay, when rates come down, what is the government trying to do? They want people to borrow money. They want people to borrow money when rates come down, because the more money that's borrowed at that point, the more spending there's going to be, the more expansion there's going to be. Okay, when rates are higher, so when the Fed had gone through the the rate hike period over the last 1.5 years or so before these recent cuts, what were they doing? They were trying to slow the economy down. Things were getting overheated. Inflation was getting overheated. So they wanted to curb the amount that people or businesses would borrow to curb spending. Does that kind of make sense to everybody? Oh man, this is a packed wheel today. I got to get my bifocals out for this one. All right. Here we go. Let's run the wheel. There it is. Today's winner, Valerie, Guillermo, Robert. Who is it? Valerie or Guillermo? Who is it? It's Guillermo. Guillermo, I know you're in the house because you just responded, yes, I see that. So I'm not even going to make you respond to that again. But what I do need you to do, Guillermo, is shoot me an email, which yesterday's winner did not do. Who is yesterday's? If you're out here, yesterday's winner. Let me go back here. I know it's here. Danny, who was yesterday's winner? I know I have it here somewhere. There we go. It was Andre. Andre, you were yesterday's winner. You did not send me an email. So I can't send you swag if you don't send me that email. Guillermo, you've got that email address to send to me, please. Prosperswag at prospertrading.com. Please, please, please email me with your mailing address and size swag. Andre, you too. Got to send me an email to that same email address. If you sent it yesterday, I didn't receive it. Please send it. Elisa, the NVIDIA contest we were just doing in the rooms, this was yesterday, and we put up a poll where NVIDIA would close today, post earnings. Thank you, Thomas. All right. That's a wrap for today. Yeah, you and me both, John. He was one away. Can you believe that? I don't know. There are 100 names on there, so 1%. He was one away. All right, guys. Thank you, thank you, thank you so much. We do have a really big, important eco data point tomorrow morning. PCE, personal consumption expenditure. That is the go-to for the Fed to see how inflation is doing. So, that's going to be a biggie. And then, excuse me, sorry about that. And then next Friday is February jobs numbers already. So this constant news cycle, this constant news flow, not going anywhere, guys. Not going anywhere. All right, everybody. Appreciate all of you. Thank you so much. We'll see you tomorrow.